Hi, everyone. I would like to thank everyone for attending the first of hopefully a series of educational webinars organized by KKS. My name is Sakis Kotsantonis, and I'm the managing partner of KKS Advisors. KKS is a consulting firm working with companies, investors, foundations, and NGOs on projects seeking to find innovative solutions that enable the creation of sustainable business models. The motivation for this webinar stems from our desire to reshape markets through impactful projects that actually most of the times we can't share due to confidentiality, and research that we can actually widely disseminate, and that's the purpose of the webinar today. The objective is to stimulate thinking, discussions, and potentially actions among companies and investors that bring systemic change. We had the opportunity to work over the past few months with 3 major organizations in the sustainability space, and you'll hear all about it in a few minutes. One of the key topics of today is what makes a sustainable company. And what we definitely know is that only a few companies are created with an integrated commitment to sustainability. To actually develop one, a company requires leadership buy-in, an ability to engage with multiple stakeholders along the value chain, engaged employees, supportive organizational culture aligned to the company's purpose, and finally, disciplined mechanisms for execution. Changing social and investor expectations have increased the pressure on companies to integrate sustainability in their business models. To do so, companies need to overcome several challenges, and this is what we want to discuss today. Our webinar will focus on some of these challenges and bring the investor perspective, which is actually critical in this conversation. So regarding the agenda, we'll first hear about how short-termism affects business decisions and potentially compromises long-term planning. A change in the status quo of corporate communications can eliminate these short-term pressures and serve the interests of long-term investors for information. Then we will talk about corporate strategy and the lack of communication channels for CEOs to deliver their long-term plans. We will discuss about new avenues for a direct communication between CEOs and the long-term investors. And finally, we'll touch on why sustainability is a board-level priority and how a clear signal of intentionality for better sustainability integration can lead to increased ESG performance. We have a great list of speakers from Focusing Capital on the Long Term, FCLT, CECP Strategic Investor Initiative, and Ceres, who will have the chance to actually introduce themselves and their organizations. And together with my colleagues from KKS, we'll take you through today's webinar. Now, before I pass it on to our first speaker, one quick logistics point. We actually want to give enough time for every question and encourage as many of our audience members to interact with the speakers and submit their questions, comments, and feedback. So instead of having a Q&A section at the end, we will be taking questions through the webinar platform, Twitter, or via email, and we actually commit to respond to each one individual after the webinar. So please feel free to interact with the speakers and us through either Twitter, email, and the webinar platform, and we will remind that at the end of the presentations. So now for our first section, I will pass it on to Sophie from KKS and Ariel from FCLT. So over to you, Sophie, to introduce yourself.
Thanks, Sakis. I'm Sophie Lawrence, a senior associate at KKS, and my work is predominantly with our investor and foundation clients on sustainable investment research and also developing impact investing strategies. I'm really motivated in my work by finding solutions that divert more capital towards social and environmental impact. And over to you, Ariel.
Thank you, Sophie. So just briefly, I'm Ariel Babcock, Research Director at FCLTGlobal, which is focusing capital on the long term. My research focuses primarily on the interactions between companies and their investors in driving shorter or longer term capital allocation behaviors. As you can see on the next slide, Focusing Capital on the Long Term is a member-supported nonprofit think tank, and we're tasked with developing evidence-based practical tools that help asset owners, asset managers, and corporations take a longer-term approach to business and investment decisions. How do we do that? So we were originally founded by BlackRock, the Canadian Pension Plan Investment Board, Dow Chemical, McKinsey, and Tata Sons, and we now have upwards of 45 members that span the investment value chain and are located worldwide. On the next slide, you'll see why we think this is important. So long-term capital allocation is really essential for creating value over time, but often short-term pressures impact those investment decision-making skills. So one area we've identified as key to driving an improvement when it comes to alleviating some of those sources of short-term capital markets pressure on public companies is the investor-corporate dialogue, or the interaction between companies and their public market investors. We find that moving away from short-term guidance and towards a longer-term communication strategy offers meaningful benefits and can really be a great first step towards fixing this investor-corporate dialogue. So as you move ahead in the slides, you'll see long-term investing is essential, and then on the next slide, long-term goals often get lost in the investment process. So even though we have savers on the one hand with very long-term goals, they're often saving for retirement, college, or a major purchase. And companies, on the other hand, who have a need for long-term capital to fund their multi-year investments in their businesses, there are frictions along the investment value chain as capital moves from the savers to the corporations, or as we could call them, asset creators. And those frictions often cause long-term goals on both sides to get lost as short-term decisions by the intermediaries take over. So, however, on the next slide, despite the short-term pressures, we do see some companies are able to follow their long-term strategies and resist the pressures in the capital markets. They ultimately deliver superior value over time. So longer-term companies, in an examination we did on this topic with McKinsey at the founding of FCLTGlobal, we found that companies between 2001 and 2014 cumulatively grew revenue 47% more than their peers, were able to grow their earnings 36% more, grew their economic profit over 80% more, and their average market capitalization over the period grew by nearly 60% more. So there's a true benefit to taking a longer-term approach to managing your business. These long-term companies also continue to invest in CapEx and R&D throughout the financial crisis. So they were really able to stick with their strategy despite market pressures, and they were punished by markets more severely. Their stocks were down more than their average peers, but ultimately those companies that stuck with their long-term strategy were able to bounce back stronger post-crisis, and we see that as the real compelling benefit of taking a longer-term approach to your business decision-making. Excuse me. So on the next slide, you'll see, despite the benefits that we clearly articulated in the prior study, there is still a lot of short-term pressure in the markets today that inhibits longer-term investment. In our C-suite survey, we found that 87% of executives felt pressure to deliver performance over 2 years or less, and that 55% of chief financial officers actually admit that they would delay a positive net present value project to hit their quarterly earnings targets. And that was despite 86% of executives agreeing that a longer time horizon would in fact improve their company's performance. So how can we fix this? On the next slide, you'll see we've identified the investor-corporate dialogue as a key area of influence on company behavior. We've done some significant research on this topic already. Our foundational piece came out in 2015, laying out 10 key items to improve the investor-corporate dialogue, and since then we've been building on that piece through a series of other publications, which Sophie and I will discuss the results of momentarily. If you move ahead to the next slide, please. So you'll see long-term dialogue is effective. Yep, that one. Thank you. There's a strong, compelling case to be made for communicating your long-term strategy. If we move to the next slide, please. Despite that case, we see that short-term guidance actually does attract short-term shareholders. So some great research done by KKS alongside Generation Foundation, as well as George Serafin with some of his academic colleagues, that found that the use of short-term language in shareholder communications actually indeed attracts short-term shareholders and comes with meaningful cost to the company. So the presence of shorter-term shareholders is associated with increased share price volatility and a higher cost of capital for those companies with the higher short-term shareholder presence in their investor base. On the flip side, on the next slide, you'll see that long-term dialogue is effective. So while short-term guidance attracts pesky short-term shareholders and causes a range of undesirable behavior when it comes to investment decision-making, long-term dialogue is actually associated with a lower cost of capital for the company, lower stock price volatility, and indeed attracts a longer-term investor base. So essentially, you get the shareholders you deserve. This longer-term dialogue can also have some ancillary benefits. So it empowers management to make strategic and operating decisions that build value over time. And it also serves as a strong defense against pesky activist investors. So companies who have articulated a long-term strategy have shareholders that believe in that strategy and stand by management in the face of activist attack. And we've seen this play out in the markets recently in a number of scenarios. The next slide, and then I'll hand it over to Sophie. You'll see that actually a majority of current investors are already focused on the long term. So 70% of shares, for example, in US companies are already owned by long-term investors. And 93% of institutional investors say in surveys that they want guidance from companies on metrics longer than 1 year. And actually, in a follow-up survey FCLT conducted this fall, we found that 85% of investors say they want guidance metrics for 3 or more years, so even longer than that 93 who wanted 1 year. Similarly, 68% of investors say that long-term guidance actually positively impacts their view of the company. So it's really clear here that using longer-term guidance and language in investor communications can bring internal benefits to the company in terms of better performance, alongside external benefits in terms of giving your primary audience, who are namely the long-term shareholders, what they actually want and need to make their investment decisions. I'll now hand it to Sophie to discuss the benefits of the longer-term communications approach and the analysis KKS performed on the influence of shorter-term quarterly guidance for us last year. Sophie?
Thanks, Ariel. Great, and on the next slide. So thinking about this investor demand for long-term information a bit more, I've highlighted here a few strong signals of this. And I have to say it was hard to select just a few, as we've seen some really big shifts in the market recently with the growth of sustainable investing. So the first one here, Larry Fink's letter to CEOs. Larry Fink being the chairman and CEO of the $6.3 trillion asset manager, BlackRock. So this has unsurprisingly received a lot of interest. His letter stated that companies need to demonstrate their strategy for long-term value creation, whilst also having a positive effect on society. A powerful statement coming from a leading institutional investor with significant ownership stake across different industries. The second comes from some results published this month of a survey of FCLT members that Ariel briefly mentioned, including BlackRock, State Street, and Wellington, with 85% of them saying that their preferred horizon for guidance from companies was 3+ years. And last summer, ExxonMobil, the world's biggest oil company, was compelled by its shareholders to be more open about the impact of climate change on its business in a historic vote. The resolution called on the company to report on how its portfolio of reserves and resources would be affected by global efforts to limit the average rise in temperatures to below 2 degrees Celsius. All its leading investors voted in favour of the motion, despite the company urging them to oppose it. I also wanted to briefly mention here a strong view that was articulated by a group of leading institutional investors and companies at a roundtable we hosted with the Rockefeller Foundation in June this year. There was a real demand voiced for the need to reach agreement on the non-financial metrics that drive long-term value, industry by industry, and for more efficient information exchange between investors and companies. If you're interested too in how each capital market participant, from asset owners all the way through to stock exchanges, are thinking about non-financial issues in their decision making, and some of the key drivers for the demand for long-term information that we're now observing in the market, look out for our Charting the Future of Capital Markets report, which will be published in January of next year in collaboration with the High Meadows Institute. Next slide, please. Now, looking on the company side, there is also acknowledgement that markets are too short-term. So some examples of that. Firstly, we've seen corporate disclosure on environmental, social and governance issues continue to increase, allowing investors to understand more about how they are managing these issues and these risks. And the information disclosed is beginning to become more forward-looking in its nature. There's also been increasing company adoption of more forward-looking frameworks and initiatives. To mention a couple, the Task Force for Climate-Related Financial Disclosures is gaining some momentum. This provides recommendations on how companies can assess climate-related risks, including using scenario analysis to assess potential business, strategic and financial implications of climate-related risks and their opportunities. The Future Fit Business Benchmark has been launched, which the top diagram comes from. This benchmark identifies the environmental and social performance thresholds that companies must reach and how they can measure their progress against them. Companies including Novo Nordisk are currently trialing the benchmark's tools. There's also been a growth in the number of B corporations using the B impact assessment to measure their impact on their different stakeholders, with now 2,600 certified B corporations across 150 industries in 60 countries. And some of them also go on to adopt a new corporate form, the benefit corporation status, to protect their mission. We've done some research for investors and companies in the past at KKS on B corporations, so have a look at our website if that's of interest. There's also been an increasing number of companies putting in place science-based targets to future-proof their growth. And finally, companies such as Unilever have for the past decade blazed a trail in corporate reporting, eschewing short-term forecasts in favour of using an integrated reporting approach that focuses on long-term strategy. Next slide, please. So there's clearly demand there from both sides, but what are some of the key challenges that we're hearing from our work with investors and companies that are preventing it from happening more effectively? One is how the information is exchanged. There isn't a one-stop shop, with multiple different channels currently being used for disclosing data, from reports, questionnaires, financial filings. Add to this the huge recent growth we've seen in data providers establishing themselves as intermediaries between companies and investors. Recent research from the World Business Council for Sustainable Development found that there are over 1,000 sustainability reporting requirements facing companies and over 750 reporting and management resources being accessed. This has led to a significant burden being placed on companies for information in different formats and investors demanding a more succinct set of value relevant and forward-looking information from companies. So overall, there's a real need for more efficient information exchange. This also links to the next point here, a lack of universal standards and terminology. There is a real need for more consistent language and more convergence of existing standards. There is also the challenge of different time horizons, of company strategy versus investment holding period. And finally, also different definitions of materiality being used, from principle-driven approaches versus compliance-driven approaches, for example, to fulfill the financial reporting requirements. Next slide, please. So a great first step, and back to the research that our team did with Ariel and the FCLT team, is moving beyond companies issuing quarterly guidance. Next slide, please. So the research found that providing quarterly forward earnings guidance is increasingly rare, with only 27.8% of the S&P 500 currently providing it. Shareholders do not want quarterly guidance. Fewer than 7% of investors want companies to offer guidance on any metric for periods of less than 1 year. It was also found that quarterly guidance can be harmful by attracting transient shareholders and increasing pressure on management to make short-term, value-destroying decisions. Providing a long-term strategic roadmap for investors can be more effective at grounding the investor-corporate dialogue. Next slide, please. Now looking at some of the research findings in turn. So this slide shows how the practice of issuing quarterly EPS guidance is increasingly unusual in the US and virtually non-existent in Europe. Next slide, please. The research also found that the guidance policy had no statistically significant effect on valuation as compared to industry peers. And finally, next slide, please. The research found that companies offering annual range EPS guidance experienced lower volatility around earnings reporting periods when compared with industry peers issuing quarterly EPS guidance. So we've heard from Ariel and I how there is a really strong demand for more long-term information. And I'm now going to pass on to Brian, followed by Christina, to tell you about some research that presents a solution for some of the challenges we've identified.
Thank you. Good afternoon, everyone. My name is Brian Tomlinson. I'm the Research Director at the Strategic Investor Initiative at CECP. So the Strategic Investor Initiative is a coalition of leading companies and investors committed to reorienting capital markets toward the long term. Strategic Investor Initiative is supported by both investors and corporations. We are co-chaired by Bill McNabb, the chairman of Vanguard, and also Alex Gorski, the CEO and chairman of Johnson & Johnson. As you'll see on the next slide, we're also supported by an advisory board of institutional investors, companies, and professional services firms, and from a range of different categories. So on the corporate side, you'll see that we have people who are both in investor relations and CSR. On the investor side, you see a mix of segments and types of investors represented, from the large mutual fund managers to some of the public funds. And in our work, what we're trying to do is responding to the call from institutional investors and CEOs to reorient our capital markets towards the long term. As you'll have seen, we've had BlackRock's call for companies to share on an annual basis their strategic frameworks for long-term value creation. That's a call that's been made over several years, although the most recent one got more attention. You've had Vanguard calling for companies to take the long-term view and do a better job talking about corporate governance. You've then had a whole slew of investors that have really been asking in increasingly formal ways for companies to improve their disclosure of long-term material ESG issues. A great data point for that would be to cite the sheer volume of responses to the SEC's concept release on Reg SK back in 2016. So in our surveys that we've conducted at our board of boards and at our CEO investor forums, we have some real sort of practitioner evidence of concerns around short-termism. 86% of CEOs feel that they're too short-term oriented. The CEOs themselves confess to that. A majority of institutional investors say that only 25% of the companies that they hold successfully communicate their long-term strategy. So as you can hear from this, we strongly share the thesis so well outlined by Ariel from FCLTGlobal. So if you're moving to the next slide, SII convenes our CEO investor forums multiple times a year to provide a venue for CEOs to share their long-term strategic plans with audiences of long-term investors. As you can see from that grid of logos, to date, we've had over 20 companies have presented long-term plans or agreed to present long-term plans at our CEO investor forums, with many more to follow. We've got a great lineup for the CEO Investor Forum coming up in February on the 25th. And each CEO Investor Forum has been attended by institutional investors representing in excess of 25 trillion in assets under management. That event is Reg FD compliant, it's live streamed, and attending institutional investors get a great opportunity to engage directly with the presenting CEOs. And at that forum, they're presenting their long-term plans. Now, we see the long-term plan and the CEO Investor Forum as an experiment in a new piece of market infrastructure just to try and fill a gap in the reporting landscape. You know, you have a very well-calibrated short-term accountability environment for companies through the quarterly earnings call. How a company sets out its long-term strategy and really pulls all those disparate strands of its strategy together and communicates that to the capital markets is less well done, and that's something that we're seeking to improve. So moving to the next slide, through leading research, you see some of the publications we've produced quite recently. What we do is assist companies in developing and communicating their long-term plans that help inform the investment and voting engagement decisions of institutional investors. The middle document there is our investor letter to CEOs, which was signed by Vanguard and 9 other institutional investors. And that was our first effort to really set out what we thought are the key elements of a long-term plan. And it's worth people taking a look at that. So we identify things like a long-term plan to be meaningful should address a 3 to 7 year time horizon. It should spend a lot of time talking about corporate governance, given the board-centric view of many long-term investors. And it should really deal comprehensively with the key megatrends and material ESG risks and opportunities that are affecting the business model over the long term. Driving this content is also the institutional investor feedback that we receive at every one of our CEO investor forums, which we then feed back into our briefing process with the companies. And having had more than 20 CEOs present these long-term plans, what we now have is a bit of a precedent deck for how companies are tackling this desire to do a better job of communicating their long-term strategy in a way that investors find decision useful. And we house a lot of those on our website. You know, terrific presentations by companies like BD, Medtronic, PG&E, and others. Really worth spending some time with those. So moving to the next slide, you know, we think there are many reasons why a company ought to share its long-term strategic plan with its institutional investors. And it's interesting that companies that have presented their long-term plans to date, and this will be released in January in a research report we're entitling The Method of Production of Long-Term Plans, have told us what their motivations were for delivering a long-term plan. And you'll see those in the top left-hand corner of that slide. You know, the primary item that people talked about was really this frustration at the earnings call. They saw it as an extremely useful short-term accountability environment, but it's not a great place to talk about those longer-term issues of sort of capital and performance, long-term issues of corporate performance. So the second point was wanting to consolidate and build on their existing disclosures. You know, really they're making so much effort to expand their reporting initiatives, but again, feel like they're not necessarily getting the pop that they expected to get from those. And again, what this desire to be a first mover in such an important space. So what one company literally described wanting to be on the right side of history. We've also set out in a piece in Sloan Management Review 6 reasons for companies for sharing a long-term plan. And again, to reiterate a great point made by Ariel earlier, you know, the way you disclose affects who holds your stock. And so we really see this desire to reorient disclosures towards the long term as being a really good investor relations toolkit to improve and enhance the number of long-term investors you have in your investor base, which is a significant priority for these companies. So moving on to the next slide, I wanted to highlight essentially the kind of 2 separate but related motivations for doing this report and research report with KKS Advisors. Essentially, we wanted to go further than we've gone with our investor letter and other guidance. And we wanted to answer essentially 2 questions. Firstly, what are the capital markets consequences of delivering these long-term plans? I.e., when a CEO comes to our forum and delivers a long-term plan, do the markets care? Do the markets react to that information? And then secondly, building on that investor letter that we published earlier in the year, you know, what are the key elements of an effective long-term plan? What does a great long-term plan look like? Can we systematize the guidance to companies to enable this to be a kind of off-the-shelf solution for them? You know, because ultimately, investor relations professionals working for companies facing the capital markets, they want to ensure that their securities are fairly priced. They want to ensure the company is well represented. They want to make sure they're providing decision-relevant information to their investors. And we also really want to meet the markets where they are. You know, if short-termism is a problem, you know, it helps us to get companies to engage with this desire to provide more long-term information if companies know that even in the short term, there are advantages to better communicating your long-term strategy. So the research is all laid out in a report that we published today entitled The Economic Significance of Long-Term Plans. And over to Christina to describe the great research done by KKS on this.
Thank you, Brian. And hello, everyone. So my name is Christina Remberg. I'm an associate consultant at KKS, where I focus mainly on helping clients understand the data behind their sustainability strategy. And as Brian mentioned, the Strategic Investor Initiative, the SII of CECP, partnered with KKS Advisors to explore this economic significance of the CEO presentations of their long-term strategic plans. And as Brian also mentioned, the really exciting news is that today we've actually published the full report together with CECP for this research. So you will all be able to read more about the methodology, the results, and the significance of these results on our website. Now, what we mean with economic significance is the existence of a market reaction to long-term plan disclosures by CEOs. And I'll walk you through our approach and key findings now on the following slides. In order to study this correlation between long-term plan announcements and market movements, we analyzed the information presented by CEOs at the CEO investor forums organized by CECP. As Brian already touched on, our approach had two main components, and I'll discuss these in more detail in a few more seconds. Combining these two streams, a quantitative and a qualitative stream, we really can start understanding whether the quality of a long-term plan is linked to the market reaction during these CEO investor forums. So in other words, we want to be able to see whether those plans that are better also have a larger market reaction. And we actually do find some really interesting results. Although we consider these results preliminary, and even though our sample size is really small, we analyzed 22 companies to date, we do find a signal in the market. To answer our first question, we constructed an event analysis and looked at abnormal returns, trading volumes, and analyst forecasts to see if there is anything additional and unusual happening during the CEO investor forum. And when doing this, we really stripped down all the potential external factors that could have biased our results. And even after doing that, we still find a signal. So this is quite exciting. Firstly, we find abnormal market returns and abnormal trading volumes during the course of the event and within 3 and 5 days after the event. What this means is that the long-term information presented at the CEO Investor Forum contains some information that investors find relevant and meaningful. So in other words, investors are trading on the information presented in these long-term plans. Secondly, when we looked at analyst forecasts, and this is actually really interesting because we don't find any abnormal reaction on top of what is expected when it comes to revision of analyst forecasts. So it seems like analysts are not revising their forecasts any differently in response to the CEO long-term plan presentations. And we see this as being consistent with sell-side analysts, being mainly focused on the short-term financial results that are given in the earnings calls rather than the long-term information. In order to answer our second question, really trying to pin down the building blocks of a good long-term plan, we did an extensive analysis of relevant literature and also invited feedback from investors. The Strategic Investor Initiative's investor letter to CEOs is the foundation that we continued building on to create this framework for a good long-term plan. Based on this exercise and through several iterations between the research team here at KKS and at CECP, we created a framework of 9 themes for an effective long-term plan. And these are the themes that you can see on this slide. Now, each of these themes have specific underlying issues that help frame the disclosure metrics. And more information on what these specific issues are underlying these 9 themes can be found in the report that we published today on our website. And this framework is really very useful in providing guidance on those issues that we have found to be value relevant. Now, in order to be able to evaluate the quality of the long-term plans presented at the CEO Investor Forum, we created a scoring method to be able to assess the disclosure on each of those themes and issues in our framework. We assessed all of the 22 CEO presentations presented at the 5 C Investor Forums to date, And our scoring methodology is based on SASB's way of disclosing, of scoring materiality disclosure. But we made it into a 4-point scale so that the more specificity, the more actionable metrics that the company is disclosing around an issue, the higher its score. So in other words, basic narrative or provision of backward-looking data gets a lower score compared to specific and actionable data points that have a forward-looking view. And this way of scoring long-term disclosures can be used to guide the long-term plan presentation by the CEO towards including the kind of specific information that benefits all parties. And we found some really interesting results here as well after we had evaluated all of the CEO long-term plans at the CEO Investor Forum. Firstly, we found variation in the quality of disclosures across the themes and issues. So it seems that companies find it easier to provide forward-looking information on issues around their competitive positioning, on their future trends, on financial performance metrics. And these tend to be issues that, historically have been assessed elsewhere in corporate reporting. So it's maybe not very surprising that these are the themes that companies seem to be more comfortable with disclosing forward-looking information on. We also found least forward-looking information on the corporate governance theme, which is a really interesting finding. It seems like it's still uncommon to provide disclosure on how the composition of the board can guide long-term strategic goals, or what the plan for shareholder engagement is, or how executive compensation is linked to long-term performance, for example. Here, a lot of companies are talking about these issues, but they're only mentioning what they've done in the past. Now, secondly, our second result here was that we found variation across the quality of the overall company presentations. And it became quite clear quickly that those companies that have a better overall score also were harder to evaluate. So it seems that leading companies included long-term thinking throughout their presentation and their plan across all themes. The disclosure wasn't provided in isolation, but rather they showed how all these separate issues linked together in an overarching long-term strategy. And on the slide here, you can see that the top 3 companies in terms of quality of their long-term plan presented at the CEO Investor Forum. There's Becton Dixon as the top scorer, followed by Medtronic, and then PG&E. What we did then was that we linked the market reaction found in the first part of our research with the quality of the long-term plan presentations found in the second part. And this, I'd say, is perhaps the most interesting results that we have. Now, it's still really early days, given the small sample, but these are really exciting signals. So what we did was that we compared the market reaction of the 5 best quality plans to the market reaction of the bottom 5 quality plans. And what we find is that there is a connection between better quality disclosure on certain issues and a higher market reaction. So specifically, we find that these 2 themes, corporate purpose and corporate purpose is measured by how the purpose is aligned with long-term strategy and whether employees feel like the work they do has a purpose. As well as competitive positioning, which relates to value drivers and how actions are linked to key milestones. So the firms that have better disclosures on these 2 issues, meaning they provide more specific and actionable information, they also have a larger reaction in the market compared to those bottom companies. So, for example, better disclosure on competitive positioning is correlated with a larger market reaction of approximately 1% in abnormal returns, and an increase in the turnover of 23.8% compared to the expected turnover, as you can see here on the slide. And more detail on these can be found in our report as well. Now, these figures are really interesting because they provide the first early signal that investors do find forward-looking disclosures value relevant, as higher content scores on certain issues also mean a larger market reaction. We believe that as we continue building on this infrastructure for analyzing long-term plans and get more companies to present, we have the possibility to understand more about these relationships and do more research that can assist in helping companies and CEOs create more effective long-term plans. To sum up, now, although we consider that our results are still very preliminary, they do provide meaningful early evidence on the market reaction to long-term plan disclosures, and they suggest that investors do trade on the long-term information provided. And if we link these findings back to the title of today's webinar, which is how CEOs and corporate boards can lead sustainable companies with the focus on the long term, the first step really is for the CEO to start talking about their long-term strategy with forward-looking information. And once they're committed to speaking about the long term, the framework that we created could be used to guide on the type of disclosures that can be the most valuable to their desired investor base. We're going to continue with the analysis of long-term plan disclosures and create a database of the content that can act as a resource for companies, investors, and researchers to create the maximum impact in reframing the corporate communications landscape. And as we've seen in our results today, CEOs are talking about corporate governance specifically, but they seem to be struggling with disclosing forward-looking information on how corporate governance is linked to their long-term strategic plan. A CEO's long-term plan should include information about how the company is thinking about their governance. And to explore this topic in more detail now is Hannah, Manager of Governance from Ceres.
Thank you, Christina, and hello, everyone. My name is Hannah Saltman, and I am a manager at Ceres on our corporate governance program. So turning to the next slide, we'll begin with a little bit about Ceres. Ceres is a sustainability nonprofit organization based in Boston, working with major companies and investors to examine and act on the financial risks and opportunities behind some of the most pressing sustainability issues of our time, including climate change, water scarcity, and human rights abuses. We do this through the four main networks on the slide here. First, our investor network, a group of 161 investors managing just over 25 trillion in assets, who work to advance leading investment practices and corporate engagement strategies on sustainability issues. Our company network, a group of over 60 companies, many of which are Fortune 500 firms, committed to realizing a competitive advantage by integrating stronger ESG practices into their core business strategies. Our policy network, a group of over 40 large companies advocating for strong climate and clean energy policies at the state and federal levels here in the US. And last but not least, our nonprofit network, comprising more than 100 nonprofits that partner with Ceres on a number of engagement opportunities to advance a sustainable economy. So moving on to the next slide, how does our work with boards fit in with all of this? The goal of our governance program here at Ceres is to move corporate boards to make better decisions for sustainability performance improvements. We focus on boards due to their immense leadership potential. They sit at the top of a company's organizational structure. They have the power to hire, fire, and incentivize management. And their networks are significant, meaning that as the average corporate director sits on multiple boards, engaging one corporate director could affect the boardroom discussions of multiple corporations. The other big reason why board oversight of sustainability is so important is the increasing interest of investors in this topic, not just on a company's commitment to relevant sustainability issues, but specifically on the role of the board in overseeing management effectively on how these issues affect the company. As fiduciaries to shareholders, directors face increasing asks from investors to demonstrate that they are serving their director duty as stewards of short, medium, and long-term value creation for their shareholders. So at Ceres, our program focuses on three key areas to do this. The first is focusing on directors as people, using the reports we've developed to engage directors on their responsibility to oversee sustainability issues when financially material to the business, as well as partnering with major director associations in the US, such as the National Association of Corporate Directors, to feature our collateral to their network of over 20,000 US corporate directors. The second is focusing on boards as institutions by engaging key company contacts, including the corporate secretary and general counsel communities that play a pivotal role in advising the board, as well as the associations that provide education and training to corporate secretaries and general counsel. And the last is by mobilizing investors to engage with boards on how they are overseeing sustainability issues that are financially material to the company. So the next slide really gets to the heart of why it matters that boards specifically oversee sustainability and how we're seeing that directors still by and large aren't doing this. Climate change and other sustainability issues, as we've heard on this webinar, pose clear business risks and opportunities. And the latest UN's Intergovernmental Panel on Climate Change report has highlighted that action on these issues is needed more urgently than ever. With some of the largest asset owners and asset managers, as we've heard, such as BlackRock, Vanguard, and State Street, calling directly for boards to be competent on climate and sustainability, we're seeing that the financial community is beginning to focus on these issues as business issues. But as you'll see on the right-hand side of the slide, directors mainly are not focused on these issues as business issues. In the most recent PwC survey of US public company directors, nearly 30% felt that shareholders spent too much time on these issues, and 40% felt that climate change should not impact company strategy at all. As these issues could materially affect corporate performance, when a sustainability issue is material to a company, directors in fact have a responsibility to educate themselves on the issue and to act. So moving on to the next slide, we'll get a bit into the impact of our work and the progress that we've seen through our governance program, which has been around for just over 3 years now. We've seen quite strong pickup amongst our director and corporate governance partners and released a number of very well-received reports on the role of boards in overseeing sustainability, which of course we'll discuss one of these reports, Systems Rule, in more depth in just a few minutes. We've used this collateral to build and strengthen our relationships with directors and major corporate governance associations in the US, including the NACD, which I introed a bit earlier, the Society for Corporate Governance, which is the preeminent association in the US, providing education and training to corporate secretaries, and the World Economic Forum, which has featured our collateral in their annual conferences and to their individual memberships, which number in the thousands. We've also embedded our thought leadership and collateral into director events and trainings put on by some of the most prominent corporate governance institutions in the US, such as the Stanford Rock Center, which directly provides trainings for corporate directors, as well as the NACD. And finally, we're continuing to galvanize investors to engage on these issues and have seen strong and steady investor interest, both in shareholder resolutions filed on board oversight, as well as through board shareholder dialogues. So turning to the last slide and turning to Systems Rule, about 1.5 years ago, we were presented with a research project to test our very own program's theory of change. We partnered with KKS to create this report called Systems Rule, an analysis of 475 of the world's largest publicly traded companies to ask 3 questions. What board governance systems for sustainability are in place at these companies? Are they any good? And does their presence on a board make a difference to the sustainability performance of a company? The results were quite informative and underscored the need to continue to engage boards on sustainability issues for better sustainability performance. And now I'm happy to turn it over to Brona to speak in more detail about Systems Rule.
Thank you, Hannah. And let me first just reiterate the importance of the work that Ceres has been carrying out for many years, providing sustainability leadership and practical solutions for investors, companies, and influential decision makers, such as corporate directors. My focus at KKS has been to develop solutions for companies to integrate sustainability in their core business model in a way that aligns with investor needs and builds long-term value. And as Hannah explained so well,
It is critical that corporate boards oversee sustainability. It's essential for good governance, and it's also part of fulfilling the legal duties that directors have to pay attention to issues that are material or relevant to their company's financial performance. And also, when thinking about what we expect to find from governance indicators, well, compared to management level indicators, which can give a picture of past and current performance of a company, details on governance systems are likely to give investors and other stakeholders holistic insights about whether the company is likely to sustain its performance into the future. So together with Ceres, we were curious to see whether the world's largest companies are integrating sustainability at the board level. So what do current practices look like? And to answer this question, we focused on a global sample of Forbes 500 companies. And due to data availability, the end sample was about 475 companies. And we also took it a step further by asking the question, what's the impact? So can we find any evidence that companies with better governance systems have stronger sustainability commitments or show better performance on sustainability metrics? So in the next slide is an overview of our key findings, and we'll explore these in more detail. But firstly, while many large companies state that their boards oversee sustainability, their governance systems are largely rudimentary or piecemeal. Secondly, companies with the right board systems we find are well positioned for sustainability performance, and this is based on our statistical analysis of governance indicators. And the third finding is that the best performing companies have integrated systems for board governance. Those include formal mandates for sustainability oversight at the board level, director expertise in sustainability, and also incentives for sustainability, linking executive compensation to sustainability performance. So if we look at current practices of the Forbes 500 companies in each of these areas, we find the following results. They're up screen. Firstly, formal mandates. So 62% of the companies that we looked at state that they have some form of oversight of sustainability at the board level. And most typically, that's through the existence of sustainability committees. But some companies do integrate it into the functions of existing committees, such as the risk committee and the audit committee and so forth. But at the same time, only 13% show what we see as truly robust oversight practices. And that means where there is both a formal board mandate and the board receives regular reports on sustainability from management. And this combination of formal mandates and board management interaction is really critical to show that sustainability oversight exists in more than name only and is really integrated into discussions at the highest level of the company. So then on sustainability expertise, the second icon, we find that most boards do not appear to have any directors with expertise in sustainability. So just 17% have at least one director on the board with that type of expertise. And that looks like an overwhelming skills gap if the board is tasked with sustainability oversight and should examine the impacts of complex environmental and social issues on corporate strategy, risk, and resilience. So boards should consider how they will get the right skills and expertise for effective oversight. And if they don't, we can expect more pressure from investors, like the ExxonMobil climate vote that was referenced earlier, where they forced a climate change expert on the board of the company because investors felt that the company simply needed that type of expertise. And then the third icon, executive compensation. We find that only 6% of Forbes 500 companies disclose connections between executive compensation and specific sustainability targets. So there's not a lot of disclosure about what kind of incentives are in place to encourage better management of key sustainability issues. And then to take it a step further and ask, so what? Before boards commit to the task of improving their governance systems, they need to know that their efforts will be effective in driving sustainability performance outcomes. And we found strong evidence that the more advanced board governance systems are, the more effective they are in driving sustainability outcomes at the management level. So board mandates for sustainability, director expertise, and linking executive compensation to sustainability are each associated with a higher likelihood of a company making strong sustainability commitments. And to give an example of what a strong commitment to sustainability is, BNP Paribas, for example, has a commitment to double renewable energy financing to 15 billion euros by the year 2020. We also find that companies with stronger commitments tend to have significantly higher sustainability performance scores, meaning that board leadership matters not only for setting commitments in the first place, but also delivering on those commitments. And then when we look at the top performing companies, the ones with the best outcomes for environment and society, we see that they have holistic board governance systems that simultaneously integrate formal mandates, expertise, and incentives for sustainability. And we found this by separating our sample of Forbes 500 companies into 4 quartiles of sustainability performance. So at the bottom, in the red, are the laggards with poor sustainability scores. And at the top are the performance leaders. And they have the best outcomes on a range of sustainability metrics, including environmental performance, human rights, and so on. And the leaders do significantly better across all 3 governance systems that we were looking into. And on the other side, companies with the poorest sustainability outcomes tended to have a piecemeal approach to integrating sustainability at the board level, or they just failed to integrate it at all. And so the evidence suggests that governance systems really reinforce each other and they're critical to sustainability leadership. So bringing it back to the question of today's webinar, how can corporate boards lead sustainable companies? Well, our key recommendations are, firstly, make board governance systems integrated and holistic by including all 3 of the systems that we looked at. And directors really must push for more than just setting up a sustainability committee. They should exercise oversight with an eye towards performance improvements. And they should also follow the leaders. So the companies that perform best on sustainability issues are those that adopt all 3 governance systems examined. And you can find case studies of companies like L'Oreal, Danone, and BNP Paribas within our analysis to see how they do it. And on that note, I will end our session on governance and bring the webinar to a close. And to sum up, today we have heard some of the challenges of short-termism, the demand from investors for more long-term information, and what CEOs and corporate boards can do to lead sustainable companies. So they can share strategic long-term plans with their investors and deeply integrate sustainability in their corporate governance systems. FCLTGlobal, CECP, and Ceres, thanks a million for being part of this webinar. And as ever, thanks to the KKS team, both speakers and the wider team that supports everything we do for the team effort. A massive thank you to everyone who joined us today, and a reminder that if you have questions or comments, we want to hear from you. What do you think? Do you have any insights from your organisation? Let's keep this conversation alive on these important topics. And I will end by linking it back to our mission to reshape markets. This is an inclusive mission. Complex sustainability challenges require the actions of many, and so please do join us in that mission. Thank you, everybody, and have a great rest of the day.